Have you ever wondered whether you can receive your first retirement pension in a lump sum? It's a common question that crosses the mind of many federal employees who are planning for retirement. In most cases, the first pension is designed to provide you with a steady stream of income throughout your retirement years. But the option of receiving it as a lump sum instead of monthly payments can be intriguing for some federal employees. So in this video, we're going to discuss whether getting a lump sum payment is a viable option for you, and if so, what are the key factors to consider? However, before we cover those details, welcome to the Money Briefing. My name is Jarrell Harvey, and I'm with Fedway Financial. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you find this video helpful, please consider sharing and subscribing. Your pension plan is one of the three components of your FERS retirement package, alongside your TSP and Social Security. Your pension is arguably the most confusing of the three to fully understand because of the different rules about eligibility, calculation, and distribution. And occasionally, those rules even change over time, which is the case with the lump sum payment option. Back in the late 80s to early 90s, most federal retirees could get their pension as a lump sum payment. However, the rules have changed. The lump sum option is also known as the alternative annuity election, and this payout option is now only available for retirees who are facing life-threatening or critical medical conditions. As I mentioned earlier, there are different rules that apply to the first pension, so it's important not to confuse this particular rule with the rules on lump sum payments for those who leave the federal government before qualifying for an immediate retirement. If you leave federal service before retirement eligibility, or if you prefer not to wait for deferred retirement, you have the choice to receive your retirement contributions as a lump sum payment, or you can roll over those funds to an IRA or a new employer plan. But again, those rules are not the same for soon-to-be retirees who want to get their federal pension in a lump sum. So in addition to having a critical medical condition, you must meet several requirements to qualify for a lump sum payment. This option can only be done for immediate retirements, and it isn't available for disability retirements. To request the lump sum, you will need your spouse's written consent, and a doctor will have to certify your medical condition. If you have an ex-spouse who is entitled by the courts to a portion of your pension or a survivor benefit, you cannot get the lump sum payment. Once you submit your application, OPM will determine whether you're eligible for the payout option. There are a few other things to keep in mind if you choose the lump sum payment. Your pension will be permanently reduced, and your payout will be determined by a combination of your retirement contributions and your life expectancy. Any deposits for military service or temporary service will also be included in your lump sum amount. However, it's important to point out, even though your pension will be reduced, the amount of any survivor benefit you provide will not be affected. Additionally, once OPM processes your payout claim, you can't switch to a disability retirement. You also cannot receive any workers' compensation benefits unless you pay back the lump sum amount. Another major factor to consider with the lump sum payment is taxes. Generally, about 80% to 95% of the lump sum amount is taxable, but the taxable portion can be directly transferred to an IRA or another retirement plan to defer taxes until the money was withdrawn. However, if any of the taxable portion is paid directly to you, you'll only receive 80% of the payment at the time of disbursement. OPM must withhold 20% for federal taxes, and you may incur an additional 10% tax if you're under the age of 59 and a half. But because of your medical condition and other special tax rules, you may be able to reduce these tax burdens when you file your taxes in the following year. Even after you receive the lump sum, you still have 60 days to roll over the money to an eligible retirement account to reduce potential taxes. If you go this route, you'll have to use other money to replace the 20% that OPM withheld if you want the full amount to be tax deferred. Despite no longer being available for the majority of retirees, the lump sum payment may still work for some. For those that don't qualify for the lump sum, but who may need more flexibility and control over their retirement funds, then the Thrift Savings Plan may be an alternative option to utilize. If you received any value from this video, please click the like button. You can also subscribe to our channel to get more content like this. If you're interested in seeing how we help our clients at Fedway Financial get the most out of their money and federal benefits, visit our website at www.fedwayfinancial.com, or you can schedule a free consultation with us by clicking on the meeting link in the video description. Thanks for watching, and we'll see you on the next Money Briefing.